Hello and welcome to Business Arena on TVP World. I'm Marie Cato. Join me for the latest business headlines of the day. Vietnam's Prime Minister has arrived in Poland, keen to deepen trade ties and explore new opportunities for defense collaboration. It's a visit that underscores both nations' desires to expand economic and strategic partnerships, especially at a time of shifting global alliances.
This is Bakalarska Street, one of many in Poland where the Vietnamese community's businesses are flourishing. The Vietnamese leader's trip is primarily aimed at boosting bilateral trade and considering potential investments in the defense sector.
Polish defense investment projects are also welcome in Vietnam. Cooperation in this area is already developing. This is an important sector of the economy nowadays. I'm very happy about this, that we will support each other's sense of security.
Trade between Poland and Vietnam has been on a steady climb, jumping from $2.11 billion in 2020 to $3.43 billion in 2024.
We are aiming to boost trade to around $5 billion. Our needs are considerable, and we know Poland has a wealth of expertise in biotechnology and the construction of boats and ships.
Vietnam is Poland's largest trading partner in Southeast Asia. The agri-food sector stands out. In 2023, Poland shipped roughly €180 million worth of poultry, fish and other food products to the country. As part of its defense ambitions, Vietnam has now expressed interest in collaborating with Poland on combat drones, particularly models like the Polish-made Fly-Eye. Such a partnership would extend Vietnam's focus beyond broad defense investments into more specialized military technologies.
And we stay on the topic of foreign trade. Data shows that the value of Poland's exports dropped by 4.7% in November 2024, causing many to worry that this trend may continue at least in the near term.
For the past 30 years, there was one source of Polish economic might: exports. However, this engine may be getting weaker. The value of Polish exports has been consistently rising at a very quick pace since the start of the millennium. Now, with this latest result, it's got many saying we won't see results above the March 2023 peak of 31 billion euros for quite some time. Exports across the European Union have been plateauing in the same way or even declining since as early as late 2022.
The explanation for this phenomena is quite simple. The same happens to exports in practically all countries of European Union, including the leader of EU exports, which is Germany.
Poland cannot escape the effects of the slowdown in Europe, and Germany in particular. 74% of its exports are destined for the EU, while 28% go to Germany alone.
Obviously, if the problems of EU, of German economy continue, I believe that Polish companies will be able to find other markets.
It won't happen overnight, but Polish producers have shown their flexibility before. In the late 90s, they were able to shift their focus from the east to the west in a very short time. Right now, the slowdown in exports can be seen in the current account deficit, which was €521 million in November, well below the market consensus of a small surplus. Polish exports to countries outside of the EU have not been affected, however. They continue growing at their previous pace.
Polish exporters are still competitive on other markets, and they are increasing their presence there still.
So Europe's current business climate is no walk in the park, but historically, the Polish entrepreneur has seen much worse.
Polish exports have been the engine of growth for the economy in the past decades, but something isn't right, as November 2024 data shows. We'll discuss the significance of Poland's drop in exports later on The Bottom Line, so stick around after the news. The Czech Republic, one of the few EU countries which remains heavily reliant on Russian oil, will soon be able to wean itself off the commodity completely, thanks to a pipeline expansion. The country's Polish-owned oil refiner hopes this transition will be achieved in the first half of the year.
This week, Czech Prime Minister Petr Fiala announced a milestone the country has been striving to accomplish for the past 3 years.
We can say that we've reached a situation where Vladimir Putin cannot blackmail us either through oil or by saying that he'll stop oil supplies.
The news comes on the heels of a successful expansion of the Transalpine pipeline, which doubled its capacity to 8 billion tons per year. This, according to Fiala, will be enough to cover the country's demand. The Transalpine pipeline sends oil from the Italian port of Trieste to Germany, from where it is directed via an interconnector to the IKL pipeline and the Czech Republic. While the landlocked country is still receiving Russian crude through the Druzhba pipeline, Orlen Unipetrol, the Czech-based subsidiary of the Polish state energy giant, is hopeful that the country will be able to cut Russian imports completely once it gets the go-ahead from the national pipeline operator.
We are already prepared for the new crude oil since the spring of the last year. And in 2023, we selected and tested suitable alternative crude oil blends. And in the spring of the last year, we adjusted the settings of the Litvinov refinery to make it ready for these alternative crude oil blends.
The transition is now possible also thanks to the company's preparation efforts, but it puts an extra strain on Unipetrol, which has to adapt 2 of its refineries to a different blend of crude.
As soon as we received the final confirmation from the state company Mero that the pipeline with the new capacity has successfully passed all operational tests and is fully functional, we can start the process of transitioning to the new crude oil blends. And we assume that this process will be completed at the end of the first half of this year.
In 2022, the Czech Republic was one of the 4 countries, next to Slovakia, Hungary and Austria, to receive an exemption from the European Commission on Russian crude pipeline imports to give them more time to find an alternative source of supply. Data from independent energy research centre CREA showed that since 2023, the Czech Republic has imported 3.2 billion euro of Russian oil. In 2024, it covered nearly half of the country's demand.
The Polish Monetary Policy Council decided to keep its interest rates unchanged on Thursday. Most experts predict the rates will remain at the same level in the coming months. Borrowing costs have been held steady at 5.75%, the same level since October 2023, in line with market expectations. Persistently high inflation, which remained at 4.7% in December, is considered the primary factor behind this decision. During December's meeting, the chairman of the National Bank of Poland, Adam Glapiński, adopted a surprisingly hawkish stance regarding potential rate cuts, suggesting that these may not occur until 2026. However, most analysts believe that the central bank will introduce cuts sooner. And that's all for our business news updates today. For more business stories, check out tvpworld.com.